Iron Financial, the only place where we cut through the market noise to help you forge a stronger portfolio. Today, we're putting Verizon on the anvil. You've seen the headlines, and they are all over the map, screaming collapse and beat in the same breath. So we're here to do what we always do, hammer out the truth and see if this company's foundation is forged from solid steel or if it's just cheap tin waiting to rust. Let's get to it.
Okay, let's just jump right into the chaos. Look at this. On one side of the ledger, you've got RTT News flat out stating Verizon Communications profit retreats in Q4. Sounds bad, right? It suggests the company's core is weakening. But then, on the other side, you see Investing.com telling you Verizon earnings beat by $0.03, revenue topped estimates. And the stock actually went up after the report. Whoa, hold on a second. How is that even possible? Profit retreats, but earnings beat. You can't have it both ways. This is exactly the kind of market confusion that makes regular investors feel like the game is rigged. Is this company a falling giant bleeding cash? Or is it a comeback story that's just getting started? That's the fundamental question we have to answer today. What is the real story here?
And to get to that answer, you need a plan. You need a roadmap. Here's our plan of attack for today. First, we're going to untangle this tale of two Verizons. Then, we'll get into the official numbers, what we're calling the gap picture, which, frankly, shows some pretty serious surface cracks.
Right, and then you're going to show us what management wants us to see, what you're calling the adjusted story. But I'm not letting you get away with just that. We're going to see if there is any real, tangible growth to back it up before we apply our own stress test to the whole thing. And only then do we get to the iron financial verdict. This is how we separate the hype from the hard reality.
You know, this isn't your typical earnings beat or miss. It's more complicated. What we're really looking at here is a single company with two completely different sets of blueprints. On one hand, you have the official audited accounting rules. We call that GAAP. And if you just look at that blueprint, it looks like the whole structure has some serious, maybe even fatal design flaws.
And then you've got this other set of plans, the adjusted or non-GAAP figures. This is the version the executives are waving around, claiming it gives a much truer picture of the building's operational strength. So our job today is to put on our hard hats, act as the inspectors, and figure out which one of these blueprints actually reflects the true structural integrity of this business. Is it solid, or is it a disaster waiting to happen?
And this is the architect behind that second blueprint, the CEO, driving the turnaround narrative. He's out there making these bold proclamations, talking about strong momentum and a new Verizon. It's a very powerful story, a very compelling pitch that he's selling to Wall Street, and it seems like they're listening.
Yeah, but a good sales pitch from the C-suite is one thing. The cold, hard financial reality is something else entirely. Talk is cheap. Our job is to get into the weeds, to scrutinize the financial bedrock of this company and see if it can actually support the weight of these grand ambitions. We need to find out if the data actually backs up the rhetoric or if it's all just talk. So let's find out.
Exactly. Before we dive into management's preferred story, their polished presentation, we have to start with the unvarnished truth. We have to look at the numbers that are governed by law, by generally accepted accounting principles, or GAAP. This is the official, audited reality of how this company performed. And let me tell you, if this is the only thing you saw, you would probably liquidate your position and run for the hills. The surface here shows some very, very deep cracks. And here it is. This is the number that's setting off all the alarm bells. 55 cents per share. That is the official, by-the-book, GAAP-reported profit for the fourth quarter.
55 cents? For a blue-chip titan like Verizon, a company that's supposed to be a stable, dividend-paying stalwart? A number like that isn't just a red flag, it's a five-alarm fire. It immediately makes you question the stability of the entire enterprise. This isn't just a minor miss or a little hiccup. This is a number that screams that there's some significant decay in the core profitability of this business.
And this slide really puts that decay into stark relief. Let's be absolutely clear about what we are looking at here, because the numbers are just brutal. Look at the net income column. In the fourth quarter of last year, they brought in over $5.1 billion. This year, in the same quarter, it's under $2.5 billion. Market skeptic.
That is a complete collapse. It's more than a 50% drop in profit year over year. And you see it reflected right there in the earnings per share, which was more than cut in half, from $1.18 all the way down to 55 cents. Look, these are not small rounding error fluctuations. This is the kind of hard, ugly data that fuels those scary headlines and creates genuine panic among investors.
And this, right here, is the central paradox. This is the billion-dollar question that separates the amateurs from the serious analysts. The official, legally audited profits were absolutely decimated. By any traditional metric, the stock should have been taken out behind the woodshed and punished severely. And yet, the opposite happened. It rallied. So why?
It rallied because the market, or at least the big money, the institutional players, chose to completely ignore these surface cracks. They looked right past this ugly picture and decided to focus on a completely different story. And that brings us to the second blueprint.
Exactly. Anyone who's been in this game for a while knows that the official GAAP numbers, while absolutely critical, can sometimes be distorted. They can be skewed by what the company calls special or one-time items that aren't part of the normal course of business. So to get a real feel for the core, repeatable performance, the hum of the business engine, you have to lift the hood and look at what they call the adjusted or non-GAAP figures.
Right. So this is management's version of the story, the one they want you to focus on. They argue it's a more accurate, a more honest gauge of the company's underlying health. So fine, let's see it. Let's see their blueprint.
So let's just be crystal clear on what we're talking about when we say non-GAAP. It's pretty simple, actually. These are financial metrics that, by definition, don't follow the strict rules of GAAP. Management takes the official numbers and then basically pulls out or excludes certain line items. These are things like one-time restructuring charges, big costs from an acquisition, or a legal settlement from years ago.
And the argument they make is that these big, lumpy events don't really reflect the true day-to-day nuts and bolts business. So by removing them, you can get a cleaner, apples-to-apples comparison from one quarter to the next. At least, that's the theory anyway.
And this slide shows you exactly what they're pulling out. This is the bridge they build to get from that ugly GAAP number to their much healthier adjusted figure. You can see they're backing out costs tied to integrating the massive Frontier acquisition, they're removing severance charges from laying people off, they're taking out costs from getting out of certain business lines. Okay, but hold on. This is where we as investors have to apply some serious pressure. The logic is that these aren't part of the core telecom business. But is that really a legitimate way to show underlying strength? Or is it just financial engineering to make the numbers look pretty? I mean, at what point do one-time restructuring charges just become a recurring cost of doing business for a company of this size? That is the critical judgment call that every single investor has to make for themselves. And the result of all those adjustments is, well, it's absolutely dramatic. On the left, you have the official GAAP story, 55 cents, a crumbling pillar about to give way. And on the right, you have the adjusted story that management is telling, $1.09, a gleaming, brand new skyscraper.
It is literally double. It's almost exactly double. This isn't some minor rounding tweak. It is a completely different verdict on the company's profitability for the entire quarter. So you're telling me that they can just snap their fingers, exclude a few line items, and magically double their profit? That seems awfully convenient, doesn't it?
And here is the crucial point. This is why the stock moved. Wall Street analysts, the people whose opinions move billions of dollars in capital, were almost entirely focused on that adjusted number. Their consensus estimate, what they were all expecting, was for $1.06 per share. Verizon's adjusted EPS of $1.09 beat that estimate. That's the headline they cared about. And that's why the stock went up. The market, for better or worse, chose to believe in the blueprint, not in the visible cracks on the surface. It's a clear signal that big money investors are buying into the narrative that the core, ongoing business is actually much healthier than the official numbers would have you believe. Okay, fine, but an earnings beat that's based on a bunch of accounting adjustments is just one piece of this puzzle. To me, that could still be just clever financial engineering. If you want me to believe in this big turnaround story, I need to see some real-world proof. I need evidence that the actual foundation of the business is getting stronger. So show me the growth, show me the customers.
He's exactly right. This is where the rubber meets the road. We need to see if they're actually building something durable or if they're just using financial tricks to patch over the cracks. So let's look at the raw materials. Let's look at the customer numbers.
Now this is the hard evidence the bulls are clinging to. 616,000 postpaid phone net additions in a single quarter.
Okay, analysts, you got to break that down for us. Postpaid net adds, what are we really talking about here? Why does this number matter so much?
These are the crown jewels. These are the highest value customers you can get, the ones on recurring monthly contracts that pay their bill month after month. They are the absolute bedrock of a wireless company's revenue. And this isn't just a good number. It's their best quarter for this specific metric in over 5 years. It's a signal that their new strategy might actually be working in the real world. And the best part? You can't adjust this number. It's a real headcount of new paying customers. And the growth story doesn't stop with those high-value mobile customers. Look at this. They also added 372,000 new broadband customers, with their fixed wireless product being a massive driver of that. You put it all together, and they added over 1 million net new subscribers across their key businesses this quarter alone. That's real momentum.
Okay, I have to admit, those are undeniably strong numbers. 1 million new customers is nothing to sneeze at. But the question that immediately pops into my head is this sustainable? Is this the beginning of a real long-term growth trend, or is it just a temporary surge because they were running some crazy promotions that will fade away in the next couple of quarters? Momentum is fantastic, but we have to see if it has any staying power.
And this right here is the long-term strategic pillar that's supposed to support all that growth, the network itself. The acquisition of assets from Frontier was a massive, multi-billion-dollar bet to scale their fiber and wireless footprint to over 30 million locations. This isn't just about winning customers today. This is about building the physical infrastructure to dominate the market for the next decade.
It's a huge strategic asset, no question. It gives them a powerful weapon to compete for broadband and mobile customers and strengthen their whole 5G network. It's a clear move to build a dominant, long-term position. But let's not forget that it comes with enormous integration risk and a mountain of debt. It's a very high-stakes, foundational play that could either pay off massively or blow up in their face.
Now, for me, this is the ultimate bull signal. This is management putting their money where their mouth is. Look at their official guidance for the upcoming year 2026. The analyst consensus, that's what Wall Street was expecting before this report, was for about $4.76 in adjusted earnings. But Verizon's management came out and guided for a range of $4.90 to $4.95.
Wow. So they are confidently, publicly projecting growth well above what the market was even hoping for. That's not just some off-the-cuff optimism on a conference call. It's a public commitment. Management is literally putting its credibility on the line with this guidance, telling investors that the momentum we're seeing right now is just the beginning of the story. That's a bold move.
All right, let's pump the brakes on all this optimism. A strong blueprint and a confident forecast are completely meaningless if the construction crew can't execute the plan. This all sounds fantastic on paper, but now it is time for a proper iron financial stress test. We absolutely have to look at the immense pressures and the significant risks that could come along and shatter this entire turnaround story into a million pieces, because one major failure in execution can make all this positive data totally irrelevant. And these are the 4 pillars that every investor needs to watch, because any one of them could collapse. First, that subscriber growth has to stay consistent. Hitting their own target of adding 750,000 to 1 million new postpaid phone customers this year is absolutely non-negotiable. Second is churn. That's just a fancy word for the rate of customer cancellations. Their improvements in keeping customers have to be permanent, not just some one-quarter fluke. Third, that massive Frontier integration is a beast of a project. Any major hiccups or cost overruns could be a disaster for the bottom line. And finally, competition. The U.S. wireless market is a brutal, cutthroat business. Can they actually win new customers without getting dragged into a nasty price war that just destroys their profit margins? A failure in any one of these areas puts the entire bull case in jeopardy. Okay, so it's time to weigh all the evidence. We've seen the deep, ugly cracks in the official GAAP numbers, and we've examined the shiny, adjusted blueprint that management is promoting so heavily.
Yep. We've looked at the real-world building materials, that strong subscriber growth, and we've just applied our stress test, looking at all the things that could go wrong. So after all of that, what is the final verdict from Iron Financial? Is this a building you want to invest in?
You know, this really is the core tension. This is what it all boils down to. The bear case sees a complete house of cards. They look at those collapsing GAAP profits, the massive new debt from the Frontier deal, and the huge execution risk, and they say this thing is ready to topple. They believe the adjusted numbers are just a smokescreen to hide the rot inside.
But the bull case sees something completely different. They see a steel frame under construction. They look at those ugly GAAP numbers and see the temporary, unavoidable mess of a major construction site. They're focused on the adjusted profits, the strong subscriber growth, and that bullish guidance as definitive proof that a solid, durable structure is being put in place for years of future growth.
So, our final analysis is this. Verizon is not a simple buy or a simple sell. It's a bet. It is a pure bet on execution. The bear case is firmly grounded in the harsh reality of those official GAAP numbers and the very real operational risks they face.
And the bull case is built entirely on the belief that this turnaround is real and that the adjusted numbers and the subscriber growth are the true leading indicators of where this company is headed. Ultimately, the deciding factor, the thing that will prove one side right and the other wrong, is management's ability to deliver quarter after quarter. This is not a stock you can just buy and forget about for 5 years. That's right. It is a high-risk, potentially high-reward wager on an incredibly complex and difficult operational turnaround.
And so that leaves us with the final question, the one for you to consider for your own portfolio. The market reacted positively to this report, which suggests it's willing to believe in the blueprint. But is the market correctly identifying a solid steel foundation being built for the future, or is it just being naive, choosing to ignore the very visible, very deep cracks on the surface? That is the billion-dollar question you have to answer. Thanks for joining us at Iron Financial.